Hey everyone, and welcome back to the deep dive. We always talk about companies that just seem to defy the odds, right? They not only survive, but thrive year after year, decade after decade.
It's true. And it makes you wonder what their secret is. Like, how do they stay ahead of the curve for so long?
Well, today we're going to explore that very question. We're diving into a fascinating book called The Founder Effect by Lawrence Lam.
Yeah, this book really gets to the heart of what drives that lasting success in business. And what's really interesting is that Lamb's approach is all about the people at the top.
Right, it's about those critical decisions being made by the management teams. And Lam argues that the best leaders, the ones who build those truly enduring companies, they share a particular mindset.
A mindset that he calls, you guessed it, the founder effect.
Exactly. Now, before we get too deep into the book itself, I think it's important to understand a little bit about Lawrence Lam himself, his background, and what led him to write The Founder Effect.
Yeah, I mean, his experience is pretty impressive. We're talking over 2 decades in the global financial markets. He's worked as an investor, he's founded his own companies, he's advised boards, and he's even been a regulator.
That's right. He started his career with the Australian Financial Services Regulator, moved on to corporate advisory at Deloitte, then had significant roles in investment banking at big institutions like Royal Bank of Scotland and MUFG, and he even launched his own investment firm.
Wow. So he's really seen the corporate world from all angles.
Absolutely. And that diverse experience is actually what inspired him to write The Founder Effect. You see, throughout his career, he kept noticing this interesting pattern.
Oh, tell me more about that.
Well, he would encounter these incredibly intelligent and motivated executives, people with all the right credentials, but they just couldn't seem to crack the code of building those truly long-lasting, successful companies.
I see. They have the smarts, but not necessarily the secret sauce.
Exactly. And then on the flip side, he'd meet these other leaders, often founders themselves, who consistently built companies that just seemed to thrive over the long term.
Hmm. So what was the difference? Was it just luck?
Well, that's what Lamb set out to discover. And what he found wasn't so much about specific skills or knowledge, but more about a certain way of thinking, a certain set of behavioral traits.
Ah, so it's about mindset, not just skill set.
Right. He calls it an intangible mindset, a collection of characteristics that weren't taught in business school, but were clearly evident in how these successful founders operated.
And these traits, this founder effect, kept showing up again and again in the companies that really achieved enduring success.
It's true. It wasn't just a coincidence. Lamb started to see these behaviors as like early indicators of long-term success, and that's what led him to develop the founder framework.
Okay, so this founder framework, it's a way to identify and assess these crucial founder-like traits in any management team. That's fascinating.
Precisely. And what's particularly interesting about Lamb's approach is that he's not relying on some secret insider information. This framework is designed for anyone looking at a company from the outside.
So even if you're not a board member or a high-powered investor, you can still use these tools to evaluate a company's leadership.
Exactly. He argues that in today's world where we have access to so much public information about companies, we can all make informed judgments about their leadership, even from the outside looking in.
That's a really empowering idea. So let's get into some specifics about how Lam developed this founder framework. Where did he start?
Well, one of his early career experiences that really shaped his thinking was his time advising corporations on hedging strategies and risk management right before the 2008 financial crisis hit.
Oh, that must have been an interesting time to be in that field.
It was. Back then, the prevailing wisdom was all about maximizing debt and using really complex financial instruments to avoid what was then considered a lazy balance sheet.
A lazy balance sheet. What does that even mean?
Well, it basically meant having too much cash on hand and not enough debt. The idea was to squeeze every last bit of return by taking on more leverage and using these sophisticated financial vehicles to manage assets.
So it was all about maximizing returns, even if it meant taking on a lot of risk and complexity.
Right. And there was a lot of pressure from financial advisors at the time to adopt these aggressive strategies. It was seen as the best practice.
I can imagine. But how did Lam approach this?
Well, as a relative newcomer to the field, he had this fresh perspective. He wasn't tied down by years of conventional thinking, so he decided to really dig into the financial statements of these companies to understand their priorities when it came to allocating capital.
Smart move. Those numbers can tell you a lot about what a company truly values.
Exactly. He realized that the financials weren't just abstract data. They were revealing the intentions of the people in charge, the management team. He could see if a company was really risk-averse, hedging against every possible downside, or if they were in this aggressive growth mode, taking on mountains of debt to fund new ventures.
And those choices really reflect their underlying philosophy about how to build a successful business.
Absolutely. And what he observed was that most companies were, for the most part, following a similar, often quite aggressive financial strategy.
They were all kind of playing the same game.
Right. But every so often, he'd come across a company that was doing things differently. These companies were often more conservative in their approach, especially when it came to taking on debt.
And I bet you can guess what these companies often had in common.
You got it. They were frequently led by their founders, and these founder-led companies exhibited a certain long-term perspective that contrasted sharply with that prevailing short-term focus of the corporate world.
Fascinating. So it sounds like this early experience really started to shape his thinking about the unique mindset of successful founders.
It did, and those insights were further reinforced when he later worked in investment banking.
Oh yeah, investment banking, that's a whole different world, right? Super fast-paced, high pressure.
It is, and the focus there is intensely short-term. You're constantly under the gun to hit those quarterly earnings targets and deliver those big annual bonuses.
So long-term growth often takes a backseat to short-term profits.
Unfortunately, yes. And Lamb saw how that short-term thinking could sometimes lead to decisions that weren't always in the best long-term interests of the shareholders.
Like they were sacrificing the future for a quick win in the present.
Exactly. And he noticed that while the investment bankers themselves were incredibly smart and capable, the incentive systems and the overall culture just didn't really encourage them to think about building something that would last for decades.
It was all about maximizing those immediate returns.
Right. And then later on, when Lamb started consulting with family offices, he gained another really valuable perspective.
Family offices. I'm curious, how are they different from, say, a typical publicly traded company?
Well, family offices often manage the wealth of very successful entrepreneurs and their families, and their goals are often quite different from a company that has to answer to public shareholders every quarter.
That makes sense. They're not as beholden to those short-term pressures.
Exactly. And many family offices, especially those with philanthropic aims, have a very different relationship with risk. They see risk as an essential part of long-term growth and wealth preservation.
I hadn't thought about it that way. So they're more willing to take calculated risks if it means achieving their long-term goals.
Precisely. And Lamb worked with one particular family office whose founder had this really interesting vision. He wanted to create a strategy focused on generating passive income, essentially an endowment, to fund their charitable work indefinitely.
Wow. That's thinking in terms of generations, not just quarters.
It is. And to achieve that kind of long-term goal, they had to embrace a certain level of risk. They needed to actively seek out new opportunities and make bold decisions that had the potential for really big long-term payoffs.
Even if those decisions carried some initial uncertainty.
Right. And that philosophy resonated with Lamb because he saw a similar pattern in the founders he'd observed building successful companies. They weren't afraid to take calculated risks in areas where they had a clear advantage.
Like that quote he mentions from Jack Gantz, the co-founder of Chemist Warehouse, "Never get into a fair fight."
Right, love that.
And too, it perfectly captures that strategic mindset of leveraging your strengths and avoiding unnecessary risks.
Okay, so Lamb has all these experiences under his belt. He's seeing these patterns emerge. Where does he go from there?
Well, all of these observations, from his early analysis of balance sheets to his time in the high-pressure world of investment banking and his work with these patient family offices, it all led him to ask a fundamental question.
Which is?
Why do some companies become these incredible engines of wealth creation, while others, even with talented people, just sort of fade away?
Yeah, the million-dollar question, right? And what's his answer? Well, his core finding is that the quality of the decisions made by the company's leadership is the key differentiator. Those choices, big and small, ultimately chart the course for the whole organization and determine its long-term destiny.
So the management team is like the captain of the ship, navigating those treacherous waters.
Exactly. They decide what products or services to offer, how to compete in the market, how to allocate resources. And Lamb believes that the best management teams, the ones who consistently make those wise decisions, they operate with a distinct founder effect.
Okay, let's talk about this founder framework. How does he actually break it down?
Well, he boils it down to three key traits. The first is bold decision-making. These leaders are willing to make tough calls, even if they go against conventional wisdom.
They're not afraid to shake things up.
Right. The second trait is the right motivations, or what Lam calls alignment. These leaders are truly invested in the long-term success of the company.
Not just chasing short-term gains or personal bonuses.
Exactly. And the third trait is commanding the masses or influence. It's about inspiring and motivating your team to achieve those big goals.
So, you need that combination of vision, drive, and the ability to rally people around a common purpose.
Absolutely. And these three traits are the foundation of the founder framework. They're what separate the truly exceptional leaders from the rest.
Okay, so let's unpack those traits a little further. Starting with bold decision-making. Can you give us a real-world example of what that looks like in action?
Absolutely. Lam uses the example of Hermès, the luxury fashion house, to illustrate this point.
Oh, Hermès, they're known for their iconic handbags and scarf, right?
Exactly. And they've been around for centuries, which is a testament to their ability to adapt and stay relevant.
For sure. So how does bold decision-making come into play in their story?
Well, in the 1990s, when Jean-Louis Dumas, a member of the founding family, was CEO, he made this really bold decision to phase out all their independently owned retail franchise stores.
That seems counterintuitive. Wouldn't that limit their reach?
In the short term, it did. It also meant investing more capital in opening their own boutiques. But Dumas had this long-term vision. He wanted to have complete control over the customer experience.
So he was prioritizing brand consistency and exclusivity over rapid expansion.
Right. And it paid off big time. By limiting volume and really elevating that in-store experience, he made the Hermès brand even more desirable and prestigious.
And ultimately more profitable.
Exactly. It's a classic example of how a bold, counterintuitive move can lead to long-term success.
It takes guts to go against the grain like that.
It does. And Lam contrasts this with those bureaucratic organizations that get stuck in their ways. They're afraid to deviate from the norm, to take risks.
And those companies often end up falling behind, like Kodak and Blockbuster. They just couldn't adapt to the changing time.
Exactly. So bold decision-making is not just about being different for the sake of being different. It's about having the courage to make those tough calls based on sound judgment and being willing to adapt when necessary.
Makes sense. Okay, so let's move on to the second trait, right? Motivations or alignment. What does that look like in practice?
Well, Lam argues that successful companies are led by people who genuinely prioritize the company's success over their own personal gain.
Like they're playing the long game, not just trying to score points for themselves.
Exactly. And he contrasts this with executives who are more focused on maximizing their own bonuses or hitting short-term targets, even if it means compromising the company's long-term health.
Ah, so it's about having that ownership mentality, that sense of stewardship for the entire organization.
Precisely. And Lam illustrates this with a hypothetical example of a company that's facing a decline, maybe due to quality issues or overexpansion.
Okay, so they're at a crossroads. What happens next?
Well, the management team has a couple of options. They could try to mask the problems by continuing to expand, even if it's unprofitable, or they could implement stock buybacks to artificially inflate the share price.
Those are short-term fixes that might look good on paper, but don't really address the underlying issues.
Exactly. And those tactics might benefit the executives in the short term, but they're not sustainable in the long run.
So what's the alternative?
The more challenging, but ultimately more beneficial path is to really dig deep, understand the root causes of the decline, and make those tough decisions to course correct.
Even if it means taking a temporary hit to the bottom line.
Right. And that's what true alignment looks like. It's about prioritizing the long-term health of the company over those immediate personal rewards.
Makes sense. All right, let's talk about that third trait, commanding the masses or influence. What's the key to effective leadership in this context?
Well, Lam argues that in today's world, it's not just about having formal authority. It's about inspiring and influencing people, creating a shared sense of purpose, and motivating them to achieve those big, ambitious goals.
So it's about building a team that's truly bought into the vision and excited to contribute.
Exactly. And the leaders who can do that, they're the ones who build those truly great companies.
Okay, so just to recap, the three core traits of the founder framework are bold decision-making, the right motivations, and the ability to command the masses.
Got it.
Right. And Lam then further refines these into three key pillars for evaluating management potential: judgment, alignment, and influence.
Okay, so judgment is about making those bold and accurate decisions. Alignment is about having the same long-term motivations as the company's owners, and influence is about winning over employees, customers, and the market as a whole.
Exactly, and those three pillars provide a really solid framework for assessing any management team.
Great, so let's dig into that first pillar, judgment. How do we know if a management team has good judgment?
Well, Lam breaks it down into two components. The first is decision accuracy. Are they consistently making the right calls?
Makes sense. But how do you actually measure that?
Well, Lam uses the fascinating story of Samsung's founder, Lee Byung-chul, to illustrate decision accuracy in action.
Samsung, the electronics giant. Tell me more. So Lee Byung-chul started out with a small trading company in Korea in a time of significant political instability, and he quickly showed his exceptional judgment by strategically moving into food manufacturing.
Okay, so he wasn't afraid to adapt and try new things.
Right. But the truly bold move came when he decided to venture into the electronics industry in the 1970s. And then, even more boldly, into semiconductors in the 1980s.
Wow, semiconductors. That's a high-tech, capital-intensive industry, especially back then.
It was. And Lee Byung-chul had very little prior experience in those fields, but he saw the potential and he went for it.
That's a major leap of faith.
It was. And it turned out to be a brilliant decision. He was able to leverage Samsung's existing manufacturing expertise and research capabilities to mitigate the risk and build a world-class semiconductor business.
So his judgment was spot on. But how do we know if other leaders have that same ability to make those accurate calls?
Well, Lam suggests looking at their track record. Have they been successful in navigating challenges? Are their earnings consistently growing? Are they gaining market share?
So it's about looking beyond just the financials and seeing if they're actually executing on their strategic plans.
Right. And it's also important to consider stakeholder satisfaction. Are their customers happy? Are their employees happy?
Satisfied customers and employees are definitely good signs.
They are. And one metric that Lam emphasizes is employee attrition rates.
Ah, so if a company has consistently high turnover, that could be a red flag.
It could be. It might indicate problems with company culture, management style, or just a general lack of alignment between employees and the company's goals.
Makes sense. Okay, so we've talked about decision accuracy. What about the other aspect of judgment, the strategic allocation of resources?
Well, Lam argues that this is a key way to amplify the impact of good judgment. It's about making sure that the right decisions are backed by the right resources, both financial and human capital.
So it's not just about making the right call. It's also about making sure you have the resources to execute on that call effectively.
Exactly. And when it comes to financial capital, Lam uses the example of W.R. Berkley, the insurance company, to illustrate strategic capital allocation.
Okay, what do they do right?
Well, they started out with limited capital, but they adopted this very conservative approach to investing, gradually building up their wealth over time.
Like the tortoise, slow and steady wins the race.
Exactly. And they avoided those flashy, big acquisitions that can often backfire. Instead, they focused on organic growth and reinvesting their profits wisely.
So they were patient and disciplined with their capital.
Right. And they used debt strategically only when it made sense to support their core business.
So it's about being thoughtful and deliberate with how you deploy that financial capital.
It is. And the other key aspect is human capital, making sure you have the right people in the right roles.
Ah, yes, the talent equation. How do great companies approach that?
Well, Lam highlights Reply SPA, an Italian technology consulting firm, as an example of a company that's really good at allocating its human capital.
Interesting. What's their secret?
Well, they have this unique organizational structure. It's like a shopping mall of highly specialized independent boutique companies.
A shopping mall of companies. That's an interesting analogy.
It is. And what they do is they incentivize talent mobility within this network. So if one boutique company is booming, they can easily shift resources, including talented people, to help them grow even faster.
So they're nimble and responsive to market demands.
Precisely. And they also have this really interesting concept of using maximum margin as a trigger for reinvestment and expansion.
Maximum margin as a trigger. Tell me more about that.
So when one of their boutique companies reaches a certain profit margin, it signals that they have the capacity to take on more ambitious projects and expand into new areas.
Lever. So they're constantly pushing themselves to grow and evolve.
They are, and that kind of strategic thinking is a hallmark of great management teams.
Okay, so we've covered a lot of ground on judgment. What about those group cognitive biases? How do they factor into all of this?
Well, Lam argues that even the smartest, most experienced leaders can fall prey to these biases, especially when they're working in a group setting.
Right. Groupthink can be a powerful force.
It can. And he highlights a few key biases to watch out for. One is conformity bias, the tendency to go along with the group even when you have doubts.
Ah, yes. The pressure to conform can be intense, especially in a corporate environment.
It can. And then there's social loafing, the tendency to put in less effort when you're part of a group and your individual contributions aren't easily measured.
Like that old saying, too many cooks spoil the broth.
It's true. And then there's commitment bias, the tendency to stick with the decision even when it's clearly not working.
Like throwing good money after bad.
Exactly. And those biases can lead to some really bad decisions.
So how do we identify these potential biases from the outside?
Well, Lam points to a couple of red flags. One is a bloated executive team.
Too many chiefs, not enough Indians.
Right. If a company has a huge executive team with overlapping responsibilities, it can lead to confusion and slow down decision-making.
Makes sense. And the other red flag.
A lack of clear accountability. If it's not clear who's responsible for what, it can lead to social loafing and a general lack of ownership.
So it's about having a lean, clearly defined leadership structure.
Precisely.
Okay, so just to wrap up our discussion on judging management teams, what are some of the key takeaways?
Well, I think one of the biggest takeaways is that even those of us who are outside the company can gain valuable insights into a management team's decision-making by really examining their track record, their strategic plans, and how they allocate resources.
Right. It's about looking beyond those quarterly earnings reports and digging a little deeper.
Exactly. And it's important to pay attention to those non-financial indicators like customer and employee satisfaction, as well as those all-important employee attrition rates.
And don't forget about those potential group cognitive biases. Always be on the lookout for those red flags.
Absolutely. So there you have it. The founder effect provides a really valuable framework for thinking critically about what drives long-term success in business.
It does. And on that note, here's a thought for you to ponder. Now that you have some new tools for evaluating management teams, what are some decisions you've observed in companies, either successes or failures, that might look different through this lens of bold decision-making, strategic allocation, and awareness of those cognitive biases?
It's definitely something to think about.
It is. And with that, we'll wrap up this deep dive into the founder effect. Thanks for joining us, everyone.
We'll see you next time.